Hi, I am semi-retired from the investment business, but I still have friends in the stock market, mainly those who run OPM, other people's money. I talk to them often because we all like the market, so I can tell you, based on my chats with them, that most OPM runners are very confused today. Why? Because there's a war in Ukraine which has been lasting more than 2 years, and a new war between Israel and Iran. And wars are the opposite of certainty. And because of that, in the market, all is panic and trepidation and confusion. Because how can an honest OPM runner figure out what to buy, what to sell? Well, as an old mentor of mine used to say, in such confusing times, look for the most important factors in the market which are now in extreme positions. Then take the top 2 or 3 factors and forget the rest. Remember, only factors which you deem are important but in extreme values. And once you find them, think about them, and the situation will then likely clarify. What are these extreme factors today? In my opinion, there are 3 of those. 1, the yield curve. 2, the panic and trepidation due to the war. And 3, the massive amount of cash in money market funds hiding from the uncertainty. The combination of these 3 factors make the market far less confusing and its direction quite clear, at least to me. Let's go over this extreme factor in order, so maybe the direction will become clear to you as well. First factor is the yield curve, or the difference between long interest rate, say 10-year rates, and short rates, say 3 months T-bill rates. Normally, long interest rates are higher than short ones, but occasionally the yield curve inverts when short rates go above long rates, when the Fed becomes stingy. When they do, the economy becomes fragile and a recession usually ensues. What's worse, the longer the yield curve inversion lasts, the deeper the recession and the deeper the market plunge later. Now, we have had a 2-year inverted yield curve, the longest in history. Remember that. The one that came closest was in 1928-1929, before the big crash in the Big Depression. Yes, that one in the 1930s. And this means that the coming recession is likely to be a barn burner without any doubts and reservations. Now, the yield curve, the one we just finished with, reinverted to positive at the end of 2024. And because the recession and the market peak rarely happen much after 1 year, we have till year end to get to the stock market peak and the start of the recession. Now, how sure I am of this? I would say 90 to 95% sure. So that's one. A recession by year end and a stock market peak by year end, plus or minus. Second factor, we have just gone through 2 wars. The one still taking place in Ukraine, still ongoing. The other in Iran, when Israel is clobbering the local army and the mullahs. And this will probably end soon, in my estimation. This, however, makes me fairly sure that we are close to a market bottom. Why? Because every time before we have such a war in the Middle East, the market always bottom at that time. You want to prove it to you? Let's count the ways. October 1973, the Yom Kippur War. It was exactly at the market bottom. Then came August 1982, the Lebanon War, another market bottom. Then came January 1991, the first Gulf War, the market bottomed exactly when the first Tomahawk missile left the ships, and the market bottomed. A huge bull market ensued. Then came March 2003, the second Gulf War, another market bottom and a huge bull market. And now comes 2025, the Israel-Iran war, started 4 days ago. In all likelihood, in my opinion, this should also be a big market bottom. Now, what about the third factor? That's the huge amount of cash hiding in US money market funds, as all the scaredy cats of OPM runners hide from the panic and uncertainty of the market. Therefore, once the market starts going up, I'm saying when, not if, they will have to buy. Why have to? Because OPM runners, that institutions who invest other people's money, they are judged on the quarterly performance versus the market, sometimes on monthly performance. So if the market goes up and they have too much cash in the portfolio, they lag the market and then they can get fired. So as the market soars, they will have to plow the cash into the market, which means that the cash will act as rocket fuel for further market rise. The obvious question is, how high can the market go? Based on the amount in money market funds and comparing the current parameter, the previous market bottoms, I would say that the S&P can rise from 6,000 here to about 8,000, perhaps more, by year-end. That's about 33%. But then will come the sting in the tail of the yield curve, because as the recession hits by year-end, the market can fall 80%, as it did in 1929, and also it did in 2001, 2003. So there you have it. My pick of the three most important market factors in extreme positions today are the yield curve, the war and the resultant fear indicating market bottom, and the huge amount of sideline cash that should make the market spike here up to year-end, at which point a big recession should hit, and the market begin to plunge about 80% as it did in 1929. Of course, although I support my view as per all the above logic, I could be wrong too. So if you think other three factors at extreme position will determine the market direction here in the year ahead, let me know what they are. That's all for today. Please let me know what you think of the above, and if you like it, subscribe to the channel and forward it to your friends subscribers who they subscribe to, and buy my books, The Sleuth Investor and The Advanced Sleuth Investor, and if you like them, please give them a review on Amazon, which I hope will be a good one. I'll see you next time, and meantime, thank you very much for watching.